and welcome. My name is Vicky Wauchet and welcome to episode 112 of A Wealthy Life. And I am again joined today by Sean, the property tax guy. If you've listened to episode 103, you'll know how good this episode is going to be and how valuable it's going to be for you, your business, your future, your retirement, your family. We're going to be covering off in this episode slightly more complicated issues of, do you put your property into a limited company or keep it in your personal name? And Sean's going to explain really clearly the pros and cons of doing that, some of the language behind setting up a company structure, some of the cost implications of it. So this is such an important episode for you to listen to, because we get so easily caught up in what's going on in social media. And when it comes to tax, it's not just that you've got an accountant. What lies behind that is HMRC. And if you like it, they're the dragon in the background. They're the ones that can breathe fire and burn down your business if your accountant hasn't helped you set up the structure in the right way in the first place. There's going to be no video of Sean on YouTube, but there will be links for you to get through to the podcast. And of course, you'll be able to listen to it on Apple and iTunes. And if you're listening to this on Apple and iTunes, you're already in the right place. So buckle in. This is a fascinating, highly valuable podcast, and I'd love you to get some insights out of this. Please make sure that you follow along, that you subscribe, that you leave a review for us, because let me know how we do and how you like the guests, and the value that you found is so important. So without further ado, let's go over to my interview with Sean, the property tax guy. Hello and welcome. My name's Vicky Wauchet, and another episode of A Wealthy Life, and another episode where we are very lucky to have Sean, the property tax accountant, with us. Welcome, Sean.
Thank you very much. It's great to be back.
So as Sean alluded to there, he has already been very kind and done one podcast with us. It was called Top Tax Tips. We'll put the link in the bottom of this so you make sure that you go back and check that out, because that will really help you understand some of the things that we're talking about here, about having a relationship with your accountant and making sure that you're speaking the right language and that you are in this relationship with them, speaking about everything, because that's going to be so important in what we're talking about today. And today I have got Sean speaking to us about the whole thorny issue of, do I hold property in my personal name or do I do it in a limited company? Sean, you introduce why the heck all of this nonsense started.
This is without a doubt the most common question that I get asked by new property investors and new clients. Why? Okay, so it is Section 24, as it is commonly known as. So this is something that was introduced back in 2017 and gradually introduced over several years. Basically, what it did was to put a cap on the deductibility of mortgage interest when calculating taxable profits from rental income from properties owned by landlords in their personal names. So that's key. So go back 20-25 years, very few property investors were using limited companies that are landlords that might own 20 properties, whatever it might be, but they'd own those properties in their own personal names. The government at the time decided that those landlords were not paying enough tax and they're getting a free ride, because the mortgage interest, they're effectively getting if they're high rate taxpayers, they're getting a 40% tax deduction for that mortgage interest. And what Section 24 did was to reduce the tax deductibility of that interest from the 40% high rate taxpayer down to a 20% tax deduction instead. Now, that I've simplified it because it's actually a tax credit instead, but I won't go into that. The point is you end up paying more tax if you are a higher rate taxpayer if you own those properties as individuals. And what that did was to prompt many property investors to start then buying properties through limited companies where this restriction did not apply. As I say, this is the most common question that I get asked, but it's worth considering is that one size does not fit all. It's all about starting with the end in mind. And it's also worth mentioning as well is that new property investors or property investors that have come to the market in the last 5, 6, 7 years have a lot of the time just assume they have to now invest through a limited company. That is absolutely not necessarily the right thing to do for them, but because of the hype, the social media, the commentary, the podcasts, they all feel that they should be doing that, and that's not always the right thing. So as I say, one size does not fit all, and it's really worth considering individuals' facts and circumstances, and that's my role to help them decide which is the most optimum structure for them.
I think it's so easy to get panicked in property. Anything, any time you're listening to the news, we had it back when we had the pandemic. Everybody was panicked about not seeing everybody and washing their hands, and we were all going to die. And then it turned out we didn't. Yes, people did, but we didn't all die. And then there was all the panic just recently with the price of utility bills. Then we've had it with the panic over interest rates going up. So it's very easy to get caught up in, as you said, some media hype and panic without going, oh, hold on, I need to understand this logically, and then I need to apply it to my circumstances to see if it's relevant. And you made a couple of very good points there. One, we're going to keep it simple. And yes, it is all about a credit rather than, so forget that bit. The point is, if you're a higher rate taxpayer and you own property in your own name, or you and your partner, you and your wife, whatever else, and it's in personal names, and you're a high rate taxpayer, then instead of being able to claim, as you could in the past, 40% tax relief on the expense, which is your interest on your mortgage, you're limited to only claiming 20%. Now, first of all, it depends how you have mortgaged your houses. Not everybody is on interest only. Some people are on capital and interest. So that's one thing to think about. A lot of people have interest only mortgages. And then to then work out about your expenses, which is where we've talked about having that relationship with your accountant so that your accountant understands the whole picture of you and your business. Because there are significant costs with setting up a limited company, aren't there?
Yes, absolutely. A limited company is a separate life of its own. It's completely separate. It's a separate legal entity to individuals that requires its own set of accounts to be filed with Companies House. It has to do its own corporation tax return. So that's on top of the personal tax return that the property investor is probably already doing. So there's a lot of fees associated with it. Mortgages, it's slightly more expensive, certainly arranging the mortgages and the legal fees associated with doing so as well. So it's not a decision to take lightly.
Let's just cover off some of those costs. Okay. So if I've got my properties in my personal name, then I keep my accounts, I have my accountant, I do my bookkeeping, and we file a personal tax return. No matter what else goes on, I've still got to file a personal tax return because either I'm an individual with or without a job, with or without a wage and some properties, I need a personal tax return, or I've set up a property company, and we'll talk about that bit in a second, but I'm still also an individual, so I've still got to do it. So whatever happens, you're going to have to do a personal tax return. If you've then set up the limited company, as you say, first off, you've got the cost of the accountants to file all of these extra paperwork. You've got extra rules and regulations that you need to apply to. You've got keeping the accounts, obviously. You've then got, as you touched on, interest rates. So interest rates are typically 1% higher if you're borrowing as a company rather than as an individual. You've got greater solicitor costs. You have to have second solicitors to sign your paperwork. You've got to have memorandums of association. You've got to have minutes of your meetings. Even when your accounts are filed, you've got to have minutes that are drawn up. So there's a lot of overheads there. And I've had one client, a lovely woman, that when we looked at what she was doing, because she's quite close to being a high rate taxpayer, she was advised that if she was going to get herself, the goal was 3 properties, that she would need to be in a limited company. She set up the limited company. It also helped because she's got children for inheritance purposes. But at the moment, she's only got 1 property, and the cost of the accountants and all of the overheads that come with running the business are basically wiping out. So she's got this 1 property and she's making no cash flow out of it because of all of the expenses.
Exactly. Yeah, that's right. And the key point to note here is it's not just the costs that you are either going to incur in setting up the company or buying a property in the company or the today's running costs. It's what are the future costs as well? So I mentioned before is you start with the end in mind. What is your plan for that property or those properties? Is if you're planning, say, to sell those properties to fund your retirement, which many people will do, then the chances are that it's actually going to be a lot less tax efficient. You'd be better off owning the properties in your individual name and paying capital gains tax on it, rather than corporation tax and then dividend tax when you want to take that money out of the company in 10, 20, 30 years time. So the questions that it's not just about the cost, it's actually do I want to pass the property and therefore the company on to my children? What if you don't have children? What if your children are going to be absolutely fine, as say you want to sell the properties to fund your retirement? All of these questions are really, really important. It's this, I tend to go through 6 or 7 different things with my clients, and ultimately there's not a right or wrong answer. It's just lots of pros and cons to weigh up, and ultimately, and for certainly my clients that are in their, say, 20s, it's really difficult to do. They might not have children yet. They might not have decided. They don't. Who knows what's going to happen in 40 years' time. For my clients that are in the 40s and 50s, it's a little bit easier, but still very, very difficult, getting your crystal ball out.
And I think the thing is that, even if you were talking to a set of triplets that all had the same circumstances, their plans would be different. So, it's a very personal thing. And as you say, there are pros and cons of all of the approaches. If you don't have that conversation before you leap in and do it, you can find yourself paying more money than you need to be paying, in the end. So just to really get that advice, don't get caught up in the hype, and make sure you have that advice. Now that then segues us into a very thin ice, we've got to be very careful about this next little piece that we're going to talk about, which is evasion and avoidance, really, tax evasion and tax avoidance. And we can all joke about Jimmy Carr and all of the other celebrities that get caught up in these things, but there are property people who get caught up in these as well. And one of the big things, another piece of the hype, if you like, is, okay, let's say setting up whatever his name is, setting up Section 24.
George Osborne.
Yeah, that's it. I was trying not to say his name because it makes me a lot. Is pre that, let's say you had 10 or 5, 10, 20 properties, doesn't really matter how many. You had a little collection of properties and they were all in your personal name. And then there's hype out there that says, well, look, if you were running that as, in a sense, a business, it was how you made your money. Maybe you didn't have a job, maybe you had a part-time job, but you put a lot of time into this and this was the thing that you did. It's easy. You can just sort of like wrap that into a company. I think it's called property incorporation. And you just lifted all of those personal name properties, dropped them into a company. And what the story is, wind it back a bit, if you did that individually, you would, as you said, me and my company are separate people. You would have to sell the property from Vicky to Vicky Limited. And in selling the property, because it's not your primary residence, you've got capital gains tax to pay. And then Vicky Limited has to buy it using stamp duty, not only stamp duty, but stamp duty at a higher rate because it's a second property. And so this idea that you could pick up properties and just drop it into a company said that you didn't have to pay any of this. Now, without revealing any names, the general principle here, what rule or tip can you give the listeners to help them understand when they're out on thin ice again?
Absolutely. It's probably worth going through a few definitions. And what I'd also say as well, just as a bit of an intro for this, is that I'm very sympathetic to landlords that have found themselves caught in this situation whereby, you know, they had many either multiple or high value properties with large mortgages that were highly leveraged, that had been doing this for a long time, and then suddenly in a relatively short space of time suddenly paying an awful lot more tax, and potentially their tax bill was actually much greater than their cash flows or their accounting profits. So I'm very sympathetic to that. So what certain professional, in inverted commas, firms were pushing were these property incorporations, some of which perfectly reasonable and perfectly legal, some of which are now being challenged by HMRC and other advisors. And so, I mean, first off, let's just go back to basics here. What was trying to be done is normally if you're transferring property from one party to another, then the person selling the property will have to pay capital gains tax, and then the party buying the property would have to pay stamp duty. And if you are if you're both the seller and the buyer, you're going to be hit twice for both types of tax and still end up in relatively the same position. You're just reducing your you're just making the mortgage interest fully tax deductible. So, you know, there's a few things here. Is you've got tax planning, you've got tax evasion and tax avoidance. So tax planning, that's absolutely legal. And all that means is that you're using tax reliefs for the purpose for which they were intended. So that is, you know, like we talked about in the previous episode, of deducting your travel expenses, for example, or tax reliefs on capital investment, or using an ISA for your savings. Tax evasion that's a legal activity where individuals or businesses deliberately omit, conceal, or misrepresent information in order to reduce their tax liabilities. So that would be things like not reporting income or overstating expenses. So again, those two things, they're the two ends of the scale. To me, very black and white. Tax avoidance is where it starts to get grey, and then aggressive tax avoidance is really where it starts to become very difficult. So tax avoidance is generally legal, but it can result in penalties and even imprisonment. So what the government considers, I've got a definition here, the government considers as tax avoidance is bending the tax rules to try to gain a tax advantage that Parliament never intended. It often involves contrived or artificial transactions that serve little or no purpose other than to produce a tax advantage. It involves operating within the letter, but not the spirit of the law. So that's the catch. And so what this really means is for in this case, what we're talking about is changing business structures with the sole intention of reducing tax.
Yeah. It's nice to actually hear you explain that, because it is technically following the words, but not what we meant by writing those words. Just because I wrote the words and I didn't think of all the devious ways that you could get around my words, you know what I meant when I wrote the words. And exactly. If you've then worked out a devious way to get around my words, to stick to my words, but have an outcome which is not what my words intended, that's where we're up the avoidance end. Okay, so there are going to be people that are already in this situation. How could they get out of it? What could they do next? And if, like, the next idea that comes up, because that's the thing, is there's always going to be another idea. There's always going to be another idea. What do you do if you think that the suggestion or the social media that you've read or the website that you're on might be in the avoidance zone, what can you do?
Yeah, again, it's a really difficult one. So again, I'm very sympathetic, empathetic to all taxpayers. It's not just property investors. Ultimately, the government will always continue to change tax rules and laws, and target certain groups. It thinks that perhaps, you know, the soft underbelly. And then naturally, as perhaps the government maybe go a little bit too far, then there will be firms out there that will try to find these avoidance mechanisms. Some work, some ultimately don't. The challenge that we have is that, you know, the courts, HMRC, etc., are always playing catch up, and sometimes that catch up can take several years. And we're now in 2023. Section 24 first started being implemented in 2017. I think it was announced in 2015. So these things take a long time to emerge. And so people can get caught by it. And when people are in pain, that's when they take action. That's what they do. Mm-hmm. And so it is a really, really difficult one. So first off, before going into these schemes, is you have to do your due diligence. Well, first off, I'd say what's the golden rule here is if it sounds too good to be true, it probably is. So that's what I always keep in mind, and that's my go-to. Secondly, in terms of doing your due diligence, recognize that if you ever engage with you know, somebody that's pushing a certain scheme, they're going to have excellent salespeople. They're going to know the pain that you're feeling. They're going to try and find and promote the solutions to that pain. Ultimately, you just want the pain to go away. You don't really care how they do it because they're the experts, right? Mm. So you need to do your due diligence. You know, check them out. Are they actually tax advisors? In one case, I believe that one is led by a barrister, not actually a tax advisor. So are they a chartered tax advisor or qualified accountant? For example, are they still registered with? They might be saying that they are a tax advisor or an accountant, but are they actually? Have you gone on to the ICAEWs or, you know, the institutes and check them out? Are they listed there? Have you spoken to some of their other clients? Have you done all the possible due diligence? Been onto the forums to see what people are saying with them? If people are asking lots of questions and if they're challenging something, that would, you know, the smell test, that would make me think, there's something maybe a little bit fishy here. I would talk to multiple firms offering the same solution. Generally speaking, if something is a get around, a legal one that works, then you're going to get, you know, dozens or hundreds of accounting and tax firms that are going to offer this service. They're just going to do it for different rates or levels of quality or speed. So if you're finding that there's only a few firms that are doing it, then that would pique my interest as well. And ultimately, you've got to talk to your own trusted set of advisors, and probably above all else, don't rush the decision. We all have that habit of, this is going to solve all my problems, just get it done and get it done now. You know, particularly with things like this, I say that HMRC can be a little bit slow to move. It might be worth waiting a few years, because it could be several years until actually it turns out the scheme doesn't work, and you end up suddenly with penalties of 100% of the tax bill plus interest. So the tax savings could be completely, you could end up paying a lot more than you've ever saved in tax, plus the tens of thousands in fees that you might be charged to put through this sort of scheme, just to save a bit of interest today, when your capital values on the house is increasing, as we've seen over the last few years. You know, house prices are going up by 20% or so. So maybe it's just not worth the effort. And then finally, you asked, you know, what should somebody do if they are involved in these schemes already? Well, all I can say is what HMRC have published, was it last week, which was contact HMRC and settle your tax affairs now. Now, I would say you're going to need a hand doing that from a decent tax advisor as well. So I would contact several tax advisors that have expertise and experience in this issue, and then contact HMRC very soon after that. But
definitely get your advice first before you contact HMRC, but don't bury your head about this.
Yes.
It's interesting, isn't it? Because I heard about this back in the day. I mean, I think the thing is, whether the government should have not made this retrospective, which is my opinion, but hey, when they announced this, there was like a 2-year lead up. And then when they fed it in, there was a 4-year implementation phase. So it was only after 6 years after they announced it that it really came into effect. So then again, you've got plenty of time that you could have done your research, but there's no point anybody who's listening hitting them with this. What we want now is lessons for going forward. And one of the things that I looked at, and I don't know what you think about this. So I have some clients whose income is 100,000 plus, and they're employed. And so they're a bit stuck because they're actual proper employees with proper wages and everything else. And so they're definitely going to be a high rate taxpayer. I then have other clients who are running their own businesses. And because the business is making a lot of money, they're taking all of their £45,000 out at the 20%. And then they're quite happy to take however much more they want out of the business. You know, the next 30,000 they're paying 40% tax on. The other thing is that I don't know what you think about this, is why don't people keep their wages below the 45 and only pay 20% tax? And then if they want more money, and let's say their household expenses mean that they have to have another 60,000, so by the time they've paid tax, etc., they need to draw another 30,000 out on the top to cover their expenses. Why don't they take those 30,000 out as dividends, which we spoke about in the last podcast, where they could be just paying 8.25 or whatever that number was?
Yes. So so what you're talking about there is when people actually have a limited company already set up. And absolutely. So I'm a strong supporter, for example, if you do own a limited company, you're a shareholder of them, and also a director, so you get to determine when dividends are paid. Is first off, use your annual dividend tax allowances regardless. And you don't even need to take the money out. You can just put the money back in as a director loan. The cash doesn't even need to move. But obviously dividend allowances have been cut recently from 2,000 to 1,000, and next year it'll be £500. But absolutely is what I would be recommending is people look at their tax circumstances each year, and in particular predict what their tax circumstances would be in the following tax year, as an example, and decide, am I better to take dividends out this year or next year, and if so, how much? Now, if individuals are running their own businesses where they get to determine their own salary, then that's great, because what you tend to do is you set an optimum salary and then pay yourself the remainder in dividends. So you reduce the amount of employers and employees' national insurance that's paid, and then take the rest in dividends. You have to be careful a little bit there, because you might need a minimum amount of salary to obtain a mortgage, for example. So yes, again, it's not just a tax-driven decision. You need to talk to your entire team, including mortgage brokers. But yeah, dividends are definitely very tax efficient. Of course, if you own the property personally, you don't have that company at the moment, then you don't have any of that control. Your tax based on the entire profitability of both your employment and what you're earning from your properties, and your properties, you can have good years, bad years, depending on whether you had repairs and maintenance and what interest rates are doing, etc.
Well, I have a lot of clients that run their own businesses. I have, and sometimes then their partners are employed. But with the customers that I have, the clients that I have, music producer, hairdresser, chiropractor, all sorts, those people running those own businesses could be making a decision within that business if their wages aren't required for mortgage purposes, which is really only on if you're going to move home. So that's what you need to think about. if they don't need to prove their wages for other reasons, keep their personal tax below the 20% mark, and then they don't need to move any of the properties that they've got in their personal names at all. And then, in a sense, we haven't done evasion or avoidance. We've just done great tax planning.
Exactly.
Good. Yes. Okay, so it's easy to panic when you hear these schemes. Yes, we are talking about Section 24 because we're talking about the company versus the personal. But if you don't panic, you get good advice, you set it up in the right place. Maybe if you run your own business and you and your husband both run companies, or you and your wife both run companies, or your partners or whatever, you can get best advice there. If we then have to go to incorporating and setting up a limited company, what other things should we be thinking about? So we've considered already the higher rate versus high rate versus basic tax. We've considered that. We've just mentioned whether you're thinking you need to move home and you need your wages for your mortgage. What else can we be thinking about in order to help us make a better decision? And obviously the first thing is speak to your own personal tax advisor. We're not giving any advice, but so that we can prep the listeners to ask good questions of their own people.
Absolutely. So there's half a dozen things that I consider when talking about, well, helping a client decide whether they want to use a company or not to purchase property. So we've already talked about whether you're a basic or higher rate taxpayer. That's a huge driver. But let's not forget as well is that a lot of people that invest in property don't even use a mortgage. They just need somewhere to stash their wealth, their savings. So with that in mind, straight away you start to think, well, hold on a minute, mortgage interest rate relief is a complete non-issue. But they might have heard the social media that says that I need to use a company. Yes. So straight away you start to think, well, it's not even a consideration if you're not using a mortgage, or you only have a very small mortgage, for example, such that the mortgage interest is so low anyway. And it comes back to your point is well, maybe the transaction costs of running the company actually outweigh any benefit. So first off, let's keep those things in mind. Other aspects is what are you going to do with the profits of the property business? If, for example, you are planning to live on those profits today, then you might find actually, well, it actually makes more sense to have the property in your personal name and just, suck it up that you're going to pay a little bit more tax. But if you're planning to use the profits to then invest in additional properties, then you absolutely don't want to be paying either 20% or 40% tax on those profits. Instead, you're probably better off to pay corporation tax at 19%. Okay, yeah, there's not much difference between the 19 and 20 as a basic rate taxpayer. But if you want to just retain those profits within a separate legal entity to invest in future properties, then a company may well be the better option. You certainly don't want to be paying 40%. And that could be a really good option. If your plan is just to grow over the next 20, 30, 40 years, then a company could make an awful lot more sense.
Because otherwise you've got this double tax idea, haven't you? That's sort of effectively what you're saying is, no matter what you do, if you're running a company and that company makes a profit, you're going to have to pay tax on that profit. Yes. If your company's not making a profit, then you're not going to have any cash in the business anyway. So we'll assume you're making a profit and you're going to have to pay, as it stands at the moment, 19% corporation tax, plus all the costs of the accountant doing the work. If because we're talking about a limited company being a thing in its own right, think of it as a box. You're outside the box because you're a person. Your company is a box and it's got 4 walls around it. If you want to take money out of that, there is a cost to taking that money out. And the primary cost of taking out is you have to pay tax, because what you're doing is you're saying, this company is giving me some money. And it's either giving me a wage, which is one set of tax based on whether you work or not, a bit more complicated. It might give you a dividend, either, that tiny amount that you're allowed tax-free, or maybe a bigger amount of dividend. But as soon as the money comes out of that box, there is tax to pay. And what you're saying is, Well, if you don't need that money to live on, and this is either a retirement plan for the future or part of a bigger goal, you're starting out, and for whatever reason you're maybe a high rate taxpayer already, you put it in a limited company, you know that your goal is to get, say, 10 properties, and you want them to generate income, and what they're going to generate is going to be your future pension when you retire in 5, 10, 50 years, whatever it is. Then keeping the money in there and not taking it out of that box and incurring tax makes sense, because that company, and we spoke about this on the last podcast, if I remember rightly, you were saying how when you set up a company, most times what you have to do is put a bit of money into the box to get the business going. So, and that's what you do through your director's loan. So after you've done your first house, if you've got some profit in there, you won't have to put more money in. You just use the cash that is sitting in the company to be the next property's deposit. And then you go again and you get cash in the company and you use that for the next property's deposit, and so on. And so the money can just stay there in a sense safely, just paying its corporation tax as it needs, but not incurring anything else. Is that right?
Yeah, you've explained that perfectly. And what I was thinking there is as you say, is if we're just planning to just reinvest the profits, yes, you're going to pay corporation tax at a lower rate than you would pay income tax. So that's good. And then, as you say, is we're keeping this money in the separate box. What happens then is you might get to the point where you're 65 or however old when you retire, is your personal tax circumstances will change. You're no longer going to have that employment income, and instead, well, you're not going to have any income other than perhaps any pensions. So then, at that point, you can start taking dividends out of the company at a very low rate, 8.75% at that point. And so you're going to pay barely any tax at that point in the future. So it is very much a wealth plan. Yeah, that's exactly what it is. Yeah, it's an investment plan for the future.
I like that idea of 8.75 when you retire as a, that effectively would be your new wage rate. And if you'd been working and paying 40% tax, coming down to taking out a dividend at 8.75 would happy days. Yes. Okay, so that's realizing the benefits of a limited company when you retire. But in between now and retiring is those thorny little creatures called children. And of course, you might go, well, do you know what? This is my approach, poor kids. I have every intention of living in happily, healthily, and everything else into my hundreds. And therefore, if I then think about the age of my kids, they're probably going to be 70 or 80. So I don't need to worry about them. They're often thinking about their own pensions. Then if I think about my grandchildren, because I worked this out, that if my granddaughter, now she has to cooperate in this thinking here for the maths, but if she has her child at 25 and that child has its child at 25, I could meet my grandchild's grandchild. Now, when my parents were alive and my grandparents were alive, my grandparents passed down, this is not limited company stuff for a minute. They passed down through their wills to my parents. My parents did a little bit to my children, but mostly passed things down to me and my sister. But now we've got to my sister and I, and medical innovations and all the support we're thinking, well, hold on a second. Where my parents probably died in their 70s, 80s, and therefore we were back in our 30s, that's not going to be the case. My sister and I have got no intention of popping our clogs in the next few years. So my kids are going to be that much older. Probably I'm going to bypass them. They might get a little, here you are, just to know that I loved you. But the majority of the money might go to my children. And I'm now thinking, well, hang on, mathematically, as I change my will over the years, I might even be bypassing my grandchildren and passing it on to my great-grandchildren. And then if I'm going to live that long, actually what I need to be doing is thinking about, well, hold on a second, I might have worked for 40 years, but I'm going to retire for another 40 years. What if I want to clean it? What if I want to cook? There might not be any money left. So it's a very complicated personal set of circumstances. But if I've created this property company, and then I'm thinking, well, whether it's my children, my grandchildren, or my great-grandchildren, how do I do this passing on thing, which I suppose maybe is a question about, are they shareholders? I mean, there's an assumption there that they would even want this gift that I'm going to leave them anyway. But if I've kept the properties and all I've done for my 40, 50 years of retirement is lived off of the eggs, I haven't killed any of the gooses. So I've got all my property gooses sitting in my property company. How do I pass that on, or what do I need to think of in order that I can prepare for passing it on?
Exactly. So the point that you made there is that you don't necessarily plan on selling any of those properties, or at least many of those properties, when you're in your own retirement. You're just going to live on the net rental income, etc. And instead, what you want to be able to do is pass on those properties to children, grandchildren. The challenge with doing that is that wealth forms part of your estate. So you could potentially be hit with, the estate could be hit with a large inheritance tax bill of potentially up to 40%, which then definitely means it will likely trigger some of those properties having to be sold just to pay the tax bill. So what many
and can I just ask, and that is because, whether it's me and my husband, etc., that is because I owned the company. So sorry, even though we've just talked about,
if you had these properties in your own name.
Oh, okay, good. Just checking. Yes. Right. So if they're in my personal name, then they form part of my personal estate, and therefore there's inheritance tax. Good. Yes. Okay.
Yeah. So if instead you own them through a company, you have a much greater flexibility here, because you can add children or grandchildren on as shareholders. You get a lot more flexibility in terms of planning what you do now. I mean, I must make it clear is what does form part of your estate is the value of your shares in the company, and that's very, very important. But if you do things cleverly and right, and also, from maybe towards the beginning, also at the planning stage, is if you bring your children or grandchildren on as shareholders, then immediately that wealth or the value of those shares, part of it is yours, part of it is the children. So in effect, you can reduce the value of your estate at the point at which it passes on, and inheritance tax has to be paid, so you pay less inheritance tax. So what that means is that, as I say, your children or grandchildren can become shareholders today, in essence. And you can actually use different types of shares. I won't go into too much detail here, but you can use different types of shares, whereby you can retain the voting rights, for example, so you can control the company still, and not the grandchildren. You don't necessarily want a 3-year-old determining, what the company should be doing. Appointing new directors, as an example, taking you off as a director.
Yes.
You can determine who receives dividends and at what rates, and when those different shareholders are paid dividends. Now, there's some restrictions there that are important to note. And then also who has access to the capital of the company upon wind up, and that's key. Is generally the parents, the grandparents don't necessarily want the capital element of the company. Effectively, it freezes the value of the shares on day one. Again, there's a lot more considerations there, but I'm just kind of illustrating the facts. So what that means is that the capital and any growth in the value of the capital is assigned to the children instead, therefore avoiding some of that inheritance tax exposure, but still allowing the parents, the grandparents, to have that dividend income to pay for, help and support, as you outlined. So that can be very powerful. Where people tend to bump into challenges is mortgages again.
Yes,
and that is the sticking point here, in that you talk about tax, and it's like, bring your children on as shareholders. So if you have 2 children and there's 2 parents, so 25% each, great. You've half the wealth has gone to the children almost immediately. The challenge then is you then speak to your broker and they say no. The lenders will only accept it if 80 or 90% of the shares are owned by the directors of the company, and they need to be adults. So invariably what people do is that only a small amount of shares in those early days are assigned to the children, if any. Then once the children perhaps go to university, for example, and they turn 18, you might allocate some more shares to them with the lender's permission, of course. And what that can mean is that then the dividends that the child receives can then be used to pay for university, as an example. Tax-free, it's coming out of their income rather than the parents' income. So it's coming out well, in a way before tax rather than after tax, because the child would have their full 12.5 grand personal allowance. So that can be very, very tax effective.
So just to pick up on that, because that is a really important thing, is that the children could get a dividend up to 12.5 grand tax-free.
Exactly, yeah, rather than the parents. Now, I have to say that the important thing to notice is that when the children are children and they're not adults, then you can pay the dividends to the children, but it'll be taxed on the parents. So the point is it's a university
only when they get their own tax allowance, which is typically 16. Is it?
Yeah, exactly.
So
I think I forget whether it's 16 or 18, but yeah,
okay,
generally,
but somewhere around there, as soon as they've got their own tax allowance, then you can make benefit from that. But also that very important point, that other very important number is a minimum of 80% of the shares. And again, I've seen people who have thought that they could save money with the accountant. It's very easy. I'm going to pick a name, Green Properties, go online. Nobody else is called Green Properties. Buy the company name, fill out a bit of paperwork with the help of a bit of Googling, and then allocate the shares, and then suddenly find that they've created a company that nobody can get a mortgage on for them. So
yes, that's it. Yeah. So again, it's about weighing up the pros and cons. But then it's also about making a plan for the future, and it might be the case, as I'm doing with one client literally as we speak. Well, not quite literally, but at the moment, which is okay. They want to bring on their 2 or 3 children. They're going to bring on the eldest because they're about to start university. They wanted to bring on them as a high, allocate more shares. Unfortunately, said no. So they're actually just going to avoid doing that, in fact, completely for several more years until that child has a really good employment income and can effectively be liable for the mortgage, a director guarantee. So that at that point, so what we're doing there is he's planning not necessarily for today, but for the future. They wanted to do this. The lender wouldn't let them. Okay, so let's defer it for 3 years. But in the meantime, we'll pay them a salary because they are actually helping out in a business. So we're still getting that same end result. Yeah, they're not getting it through dividends, they're getting it through salary, but they're paying next to no tax, same end result. So we've come up with another solution. As soon as they do have employment income of over 25 grand, whatever it might be,
to meet the lender's requirements.
To meet the lender's requirements, we'll bring them on as a shareholder, by which stage their next youngest child will be old enough, will become an adult, and will run through the same practice again. But you know what? The laws might have and regulations might have changed in those few years, so we might end up having to do something slightly different.
Yeah.
So that's why it's always about working with an advisor to make sure you're working to current rules rather than a blog post that you read 3 years ago.
Very definitely. Don't, please, if there's one thing that you take from these podcasts, do not rely on blog. There you go. That's another one of those words, isn't it? Do not rely on blog posts for your tax advice. Actually, it's the relationship that counts. The other thing that we picked up in the last episode, which again, you'll find the links at the bottom, is we talked about the additional costs of setting up a company. So just very briefly was interest rates on your mortgages are going to be more. You're going to have legal advice in terms of signing things. And then you've got the whole accountancy costs of administering the property. So to sort of summarize this, as with everything, tax and financial advice is very, very personal. Don't automatically assume you need a company. Speak to your accountant, and going with the previous podcast we spoke about, make sure that you've got that relationship and that your accountant speaks to you in a way that's right. And it's not just your property plans. Your property plans are important to the company. How you're going to live, and this is called a wealthy life. What are your plans for your wealthy life actually is there as well, because that should really be at the top. And then the property plans are going to generate the income for your wealthy life. And then if there's any money left over, what are we going to do with the kids, the grandkids, and the great grandkids lying underneath? That's fine. Got all of that. I've got all of that. And I hope the listeners have got all of that as well. Now, there are types of companies. And I know that if you've done your own, go buy your own company name. What about all these codes? Are they, I don't know what the SIC stands for, but they're a code.
Industry classification code.
Okay, thank you. So what is my standard industry classification? Does it matter if I'm holding properties in terms of I'm just going to buy them and rent them versus if my plan is to buy and sell them? Should I have different companies? And then some people are always talking about SPVs, which I do know what that stands for, special purpose vehicles. What do we do about, okay, so we have made the decision that we're going to set up a company. We do know what our wealthy life plans are. We do know what the property plans are to generate the wealthy life. And we've got a vague idea of what we're going to do with the kids if we still like them. What about the structure side of things?
We still like the children, brilliant.
Yeah.
So yes, well, let's talk about SPVs for a start. So the property and mortgage industry love to make up terms, and SPV, special purpose vehicle, as you said, is absolutely one of those. An SPV doesn't actually have any legal recognition at all, actually, or the term itself. What it actually means in practice, it just means it's a company that has a specific SIC code, standard industry classification code. A standard industry classification code is a way of describing what a company sets out to do. And often, and you see this when people set up their own companies rather than using an advisor to do it, is they often say, well, I might do a bit of flipping, I might do a bit of property investment, I might do a bit of rent to rent, I might do a bit of letting on the behalf of other people that own properties. And so they assign 4 different SIC codes. A lender then comes along, looks at that when you're applying for your first mortgage and goes, well, hold on a minute, which of these things is the company going to do? And is it going to do all of them? Is it doing them all now? Will it do more in the future? And the lender then starts to have a little bit of a heart attack. And the reason for that is that they like companies with just one code, making it an SPV, that is just going to do one thing, because ultimately what's the lender doing is lending you money, it's taking on risk. And it wants to know that company is definitely going to repay that loan. So it's all about risk management. And if it sees a company that is set up that is either doing or going to do both property investment, plain vanilla buy-to-lets as an example, but also flipping, which is actually property trading. It's not property investment, it's trading. It's a different way of being taxed. It's a different way of operating. Then the lender starts to get worried then, because it sees flipping as much more risky. Reason being is flips are notorious for going wrong, because either the work costs more, it gets delayed, property prices changes, the market changes, the property might reduce in value over the course of the refurb, as an example. And then the lender will then think, well, hold on a minute, if the flipping side of the business has problems, will the investment side of the business still be able to repay the loan on a monthly basis? And it will say, it might find that it's not. So what the lender will say is, look, you've got to be doing this in 2 different companies.
Yeah.
And so that's what I will, help my clients in setting up those two different companies. If that's the case, very little point in setting up a company if you're not ready to do that second business at the moment. But if you know that you are definitely going to do it, then it may well be worth setting up what's called a group structure. But before I move on to that, I'll just pause.
Yes, let's pause there. Okay, so I learned something there. I didn't realize that an SPV is just I knew it was a single purpose entity, but I always thought that it was short-lived. So I thought you only used an SPV when, for example, you and I decided, and I'm very against joint ventures, but I'm just using it as an example, you and I decided that we were going to both put our money into a deal and we were going to buy it, do it up and flip it. So there was a short term there, whether it was a year or 2 years, that we were coming together for that special purpose of buying this specific house. And then we were going to sell it. And when we've sold it, we would take our money out of the company and close the company. So it's really interesting that actually the special purpose of it is really saying to your lender and to everybody else, and very specifically to you, that when I am in this box of my business, this is what my focus is. I'm all about buying vanilla buy-to-lets, holding them, managing them well, and reaping the cash flow. When I'm over in this other box that I may then choose to set up, I'm doing either rent to rent and letting, or I'm doing flipping, or whatever it is. And as you mentioned, there are different ways, different taxes that apply to the flipping side of the business than they will to the hold. So we won't go into that because that's way too complicated again. Let's come back to that, what you were saying about the use of the group structure. So I know a few of my clients have had it where it's like a pyramid in a sense. There's the holding company at the top, and then there's some little bodies down the bottom.
Yeah, that's you've outlined that perfectly. So I often recommend my clients set up a group structure on day one if as I say, they are definitely going to do multiple types of business. So the default really is the property investment, buy-to-let, HMO, whatever it might be. But then they say, well, I might do these other lines of business in the future. And I say to them, I says, well, is that just an idea, something you might feel like doing, or is it something that you're definitely going to do? And if it's a hard, definite, yes, they are going to do that, then what we then consider is setting up a group. So what that means, as you say, Vicky, is first off, you set up the holding company, and the holding company has no other purpose other than to own the shares in other companies within the group. So you set up the holding company, that's number one. Then number two, you set up the property investment company, the SPV, for doing your buy-to-lets. That means then the shareholder, the client, doesn't actually own the shares in the property investment company directly. They only own the shares in the holding company. They ultimately have the ownership, have the ultimate beneficial ownership. They just don't own the shares directly. So say, for example, if they do want a dividend, the dividend has to go via the holding company. So there's a little bit of admin that happens there. However, there's big tax savings to be had here. So if, for example, you had a flipping company and an investment company, and you did not have the group structure, typically the flipping company is often, if it's gone well, you'll earn some really good profits. And often people will use the flips to fund future investments. That's the common strategy that I see. So they do a flip, they make a 30 grand profit, and then they go off and buy a property with doing the buy-to-let. Now, if they owned that flipping company directly rather than through a holding company, they're going to have to pay dividend tax. If they're high rate taxpayer at 33.75%, so suddenly you've lost over a third of those profits. So 10 grand in tax. So you now only have 20 grand to invest in a buy-to-let. That might not be enough. Who knows? Depends on the type of property you buy.
Because that box that is the flipping box is a box, and that's where your 30k is. And then over here is your investment box, which is a completely separate box. And you've got to take money out of that box to put it in that box. And that's why you've got to pay tax.
Via you as the shareholder of both companies.
But if you were a holding company box at the top, are the two little boxes inside that big box?
They're below it. So,
yes, they are below it. But in a sense
they're all part of one big box.
Oh, yes. Okay. So because I like the visuals. So the holding company is a box, the investment company is a box, the flipping company is a box, and then in a sense there's another box all the way around the outside.
All around the three of them, yes.
Yeah. So within the three, they can pass the money backwards and forwards, and they've not come out of the bigger box There's many
Yes.
boxes in this analogy. They've not come out the bigger box, and therefore you're not paying those additional taxes.
Exactly. So if it was
Well,
part of a group and the flipping company made the profit, it would pay a dividend up to the holding company, and it wouldn't pay. There's no dividend tax to pay when it's transfers of profits within a group. And then that holding company could then move the money into the investment property, and it would go ahead and make all of those investments. You as the shareholder, it's not touched you at all because it's all part of a separate legal entity. So that's why groups are very, very common. And yeah, as I say, when people definitely going to operate those multiple strategies, and they've already decided that investing through a limited company is the right thing to do, then it's definitely it's almost always the right thing to do.
that's awesome. So look, another question, I don't know whether I'm opening a wormhole here. So we've got our triangle of companies, so the flipping company, the investment company, and the holding company, and they are all in the protection of the box. I have not allocated shares to my children down here in the investment company because the only person who is the shareholder of the investment company is the holding company.
Yes.
But I can allocate shares to my children up here in the holding company.
Yes.
That bit's right. When the lender looks to lend me money on my vanilla buy-to-let that is in Vicky Buy-to-Lets Limited, they will then see that the shareholder is the holding company. Will this whole I must own 80% of the shares thing come into effect if 100% of the shares of Vicky Buy-to-Let Limited is owned by Vicky Holding Limited? Is that 100% share ownership by the holding company enough to get me round the rule? Don't want to be too around rules. So that I can still get the mortgage, even though maybe Vicky Holding Company has done that thing that you were talking about. We've all got 25% of the shares each.
The simple answer to your question is yes. Now, I can't provide advice on that because I'm not a broker or anything like that. But what I've seen in my experience is that the lender will absolutely look at that buy-to-let company. It will say, well, who owns that company? It's a holding company. Okay, who owns the holding company? It will do that full look through. I mean, ultimately, particularly for new property investors, the lender's going to want to take out personal guarantees on the directors anyway. Yeah. So it's going to look all the way through, and that's where it's going to want to see who are the directors, who are the shareholders, are they consistent? Is there that 80-90% rule?
Oh, so they will still want the 80-90% rule up there.
Yeah.
Okay.
Absolutely.
So it's not a way to get around it at all. So the thing is no. Okay. No. So in terms of companies, summing up, be specific about the purpose of the company. It's an SPV. It should have one standard industry code. Is that the
classification code?
Classification code. Yeah. Because otherwise it said code. So it's a single purpose vehicle with one standard industry classification code, because it has to be focused to make the lenders happy. If you know you've got the bigger plan and you know that what you're going to do is flip to generate capital and then use capital to buy your buy-to-let, then flip again to make more capital, etc., etc., setting up a holding company for day one is the right potential. Check all with your own personal advisor, right way to go, because you are going to save extra money taking things out of boxes, etc. And it's probably a good idea to set this up day one. And then it's your holding company that would have that whole, if you like, conversation with itself about who am I going to give some shares to, still make sure that you abide by that 80-90% rule. And so what's required here is not only the conversation with your financial advisor, because sometimes I've heard people have the conversation with their accountants and they haven't had the conversation with the financial advisor. And so they weren't aware of, let's call it the 80% rule. And so the accountant has gone ahead and set up a company, allocated all the shares to the kids, which is what the new business owner said that they wanted, and then not thought about this. So in everything that you do, you've got to make sure, hang on a second, I've had my advice from my accountant. Do I also need to check this with the broker? Yes, I probably do. I don't know if we ever really need to check things with a solicitor, but maybe you will. Or if your accountant doesn't do inheritance, and it'd probably be better if you had that idea, on tap as well, have that conversation there. So it's not just you that is the be all and end all of my advice. You're the very important relationship that I have in my business, because you can see the whole picture. But I have to remember that I've got to go outside sometimes to just double check, not double check in the way that we were talking about before, that you're doing anything dodgy, but double check some implications. Is that right?
Yeah, absolutely. And what I would also recommend, and this is what people probably don't do enough, is if necessary, and particularly if you're not necessarily skilled yourself in tax, accounting, lending, law, legal aspects, is bring the relevant parties onto the same call. It's so easy to organize, a Zoom call.
Yeah.
Get the 2, 3, 4 parties on the call all together, have an agenda in advance, and have them all thrash it out, because they're all going to come with different perspectives. Approaches. Yes, and some will work for some will not work for others, and it's about finding the optimum solution. There's never going to be the perfect solution, I'm sure, but you'll be able to find the one that ticks most of the boxes, and it's about finding that right solution for all. And I think if you've got good professional advisors on hand, they'll be more than willing to do that. If anything, those conversations can be quite fun, and in fact the advisors themselves they find those conversations quite beneficial, because they can then learn new things that they can then share with their other clients.
Yeah, absolutely. And also upskill their own knowledge, so that the next time we come to this, we don't have to go through this again.
Yes.
Sean, this has been obviously a bit more complicated for people, but I still think a really valuable conversation. It's so easy. I mean, it's almost like I wish we'd gone back in time and had this conversation 6 years ago and 4 years ago and all of the other times. I mean, I hadn't got the podcast at that point, so it's irrelevant. But if you take anything from this while listening to this podcast, it's have that relationship with someone that you can understand what they're talking to you about. I hope that in listening to Sean, you have understood everything that he said. If you haven't, just listen to that section again, because sometimes there are a lot of words and you might miss a word and you might just want to catch it again. But at the end of this, when you have listened to this podcast once or twice, you should understand about the pros and cons, potentially, and I'm going to put the word potentially in for you, of whether you have a limited company or you keep your properties in a private name. And then take that potential understanding and go and get it checked by your own accountant. And as we said in the last podcast, that is someone that you have interviewed, that you have checked out, who knows you and who you have a proper relationship with. So you don't just rely on them once a year to show up and tell you what you did. They are aware of what's going through your head all the time. Now, having said that, you don't need to chitty chatter to them all the time. You're going to them with a clear business question, and they can then help you. And I think if you take that away from this, that will be a win for me, a win for you. Sean will have done a brilliant job. Obviously, he's done a brilliant job anyway, but hopefully you recognize that Sean's done the brilliant job as well. So, Sean, any last, 1, 2, or 3 things that you want to drop in for people, just as a reminder of what you've been saying?
I think you've hit the nail on the head there, actually, Vicky. I mean, if I can go away from this and think that as we don't know what we don't know, if that has then initiated a conversation with a professional advisor for your listeners, and that conversation is a little bit more well structured, and it's provided some questions for your listeners to be able to ask their professional advisors and really kickstart a really good detailed conversation, then I would feel like I've done my job today.
Yeah, and I think that would be an amazing result, because then, I just think time is such an important asset that we have that is undervalued. I'm so grateful for your time over these 2 podcasts. that yeah, I'd like you to think that this was time well spent. It certainly has been for me, but I'm glad that it could be well spent for you. So all that leaves me to is to say thank you to you. There will be lots of notes at the bottom of this podcast and the previous ones. There'll be links to that. There'll be links to Sean. There'll be links. So that, you know, what we haven't mentioned, or I didn't mention the last time, is that Sean's got a newsletter. You can get on his newsletter. I love reading it. It comes out every couple of weeks. If you don't want it front and center, he says, here's the unsubscribe. So if you don't find it of value, you can just go. I've been there, I don't know, ever since I came across you, so a good few years pre-COVID. And I have to say, it's the one thing that I do read every time it comes through. And I have a folder called Follow Up, and I have saved every one of your newsletters in there because they are full of value. It might be that not every topic you describe is 100% relevant to me, but there is always something in there. There is always a nugget that I take away, which is why I have fought for so hard to get you on the podcast. Sean, thank you for your time. I really, really appreciate it. And I know that the listeners will have got lots of value out of this.
Absolute pleasure. I've thoroughly enjoyed it. Thank you for having me.
My pleasure. So just to say to you, and to make sure that I put a little bit of whoosh into your life, understanding the accounts and the tax side of running a business, any business, is absolutely crucial as a business owner. You may not be the best person with an Excel spreadsheet. You may not even like the maths of it, but you do need to understand the income, the expenses, what profit means, some of these words, which is really English. It's not even maths anymore. It's English. It's understanding that. And you need to have someone in your team, and we both loathe the term power team. You need to have a professional that you can reach out to that can do this. Don't think, as so many people do, that doing your own Excel spreadsheet to keep your bookkeeping and filing your own tax returns, your personal tax returns, is saving you money, because in the long run, this will all come back to bite you on the backside. So my name's been Vicky Wachet. We've been very lucky to have Sean, the property tax accountant, with us over the last couple of podcasts. Please make sure you read the show notes, because there'll be loads and loads of links there. And of course, if you've enjoyed this, please review the podcast itself, whether it's on Apple or it's on iTunes. Please make sure you subscribe so that you get access to all of the future podcasts that are coming. And if anything, I hope you have a wealthy, tax prepared and well planned life going forward.